Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. stocks. S&P rejects SPCX Fast Track, index updates, and market breadth. This video presents a direct informational narration of the source document. We've got 6 main areas to cover today. We'll be looking at market breadth divergence, recent labor data and AI-related job cuts, healthcare target upgrades, the mechanics behind the massive SpaceX IPO, timelines for index inclusion, and finally, semiconductor technicals. Starting right off with Section 1, market breadth divergence. Let's look at a pretty rare structural divergence we're seeing right now. The Nasdaq just had its largest single-day drop relative to the Dow in 17 months, and that was mainly dragged down by Broadcom and the broader semiconductor sector. But here's the interesting part. Underlying market breadth was actually incredibly strong. We saw 363 S&P components advance, with 9 out of 11 sectors rising. So while big tech took a breather, the source data shows capital broadening out into other sectors, which signals underlying resilience. Moving into Section 2, we're looking at labor data and AI job cuts. Looking at the macroeconomic picture, the latest labor metrics show some unexpected weakness. For the week ending May 30th, initial jobless claims took a sharp turn upwards, hitting 225,000. That's a notable jump past the expected 213,000. On the flip side, continuing claims actually dipped slightly to 1.77 million, which is just under expectations. It's a key data point the document highlights for tracking early signs of economic cooling. And here is a really fascinating structural shift. In May, U.S. employers announced 97,000 job cuts. But the standout detail here is that artificial intelligence was cited as the primary reason for over 38,000 of them. That is a staggering 40% of the total monthly layoffs across all sectors. The data strictly points to aggressive corporate restructuring designed specifically to adapt to an AI-driven economy. Section 3 covers healthcare target upgrades. Specifically, United Health Group, or UNH, has been catching some serious institutional attention lately. Major institutions have suddenly upgraded the stock, driving immediate passive capital inflows. Bank of America raised its price target to $450, and Morgan Stanley pushed theirs to $453. As the document notes, this coordinated backing really illustrates where capital is flowing as it seeks defensive yet growing safe havens. But there's an important valuation constraint to keep in mind here. As UNH nears that 440 to 450 range, it's actually hitting its 2027 forward valuation median. Essentially, the price has rapidly priced in its future growth. So, according to the source, if investors are looking at historical highs near $600, that mathematically requires a multi-year investment horizon, because the short-term upside is capped by these forward valuations. Next up is Section 4, SpaceX IPO mechanics. Now, let's break down the mechanics of this massive offering, because it's structurally unique. They're completely bypassing the traditional price range discovery process. Instead, after a 1-for-5 internal split, the IPO price is fixed at $135 a share. They're issuing over 555 million shares to raise an unbelievable $75 billion. This gives it an initial valuation of roughly $1.75 trillion right out of the gate. If you're planning to follow the initial trading, there's a crucial mechanical detail you need to know. The stock will not just start trading normally at 9:30 a.m. It's going to go through what's called the NASDAQ cross process. This means there's an initial public display period that usually lasts about 10 to 40 minutes. During this window, institutions balance the massive order book. The official opening price is going to be dictated purely by market demand matching up those buy and sell orders, not that fixed $135 issue price. Moving to Section 5, let's look at the index inclusion timelines. Integrating a $1.75 trillion asset creates staggered waves of passive buying depending on the index. The Nasdaq Composite will add it in a matter of days. The VTI index does it after just 5 trading days, and the Russell 1000 should absorb it within a week, or by September at the latest. That means massive, forced institutional buying pressure almost immediately. However, there is a major regulatory roadblock with the S&P 500. The S&P Index Committee officially rejected a proposal to waive their standard profitability rules for this IPO. Because they require a strict history of positive earnings, SpaceX cannot be fast-tracked. They have to wait until at least 2027, which completely alters how mutual funds will handle the stock in the interim. And that brings us directly to the investment risks. The source data outlines some severe risk factors that need to be weighed neutrally. At over 90 times projected 2025 sales and currently operating at a heavy loss, the valuation is extremely high. Combine that with a high retail allocation and massive public sentiment, and you've got the mathematical likelihood for extreme initial volatility. The document explicitly notes that participating at these levels carries the absolute risk of a total loss of principal. Finally, Section 6, Semiconductor Technicals. The document points out that the sheer liquidity requirements for the SpaceX IPO might actually be draining capital from semiconductors right now. Looking at the SOXX ETF, it's testing near-term support bands strictly between 556 and 570. But if that breaks, the hard historical support sits all the way down at 368. We see a very similar setup with the SMH index. It's showing moderate upper support between 558.9 and 613. But just like SOXX, its much stronger historical support is positioned significantly lower at 419. If capital flight breaks those near-term levels, it's a considerable, uncushioned drop to those historical baselines. What we're looking at is a calculated de-risking maneuver happening right under the surface. Institutional funds are taking profits from highly extended tech runs and rotating that capital into defensive sectors like healthcare, or they're just reserving pure cash liquidity to participate in this massive upcoming aerospace IPO. So the central question the source leaves us with is this. As the market processes this historic $1.75 trillion event, will this IPO draw terminal liquidity away from tech stocks, or is it going to pull fresh capital off the sidelines and ignite a broader, more aggressive market phase? The structural flow of institutional capital over the coming days will give us that answer.